Hello everyone, this is Hema working at Sai CPA Services as a senior accountant. Today we are here to discuss on the topic going around. I've been hearing around that IRS is eyeing on wealthy taxpayers. So today we have Mr. Kumar here with us and we will ask him how far it is true and how much funding the IRS is getting to scrutinize the taxpayers. Yes, Mr. Kumar.
Absolutely, Hema. Thank you. Yes, everybody is talking about it. Everybody is making fun of it. That IRS is getting special funding. Yes, it is true. IRS got $70 billion recently just to hire more people. And in theory, these new people are supposed to be trained for complex audit, complex tax returns. But who has the complex tax returns? People who have a W-2 job, their tax return is not complex. So this $70 billion funding is expected to scrutinize high net worth clients. And IRS is expecting to make $700 billion over the next 10 years from this training, from this investment. Where else can you get 10 times returns over 10 years if not at IRS? Yes, so it's true that IRS is hiring special revenue agents. IRS is training the current revenue agent for the more complex audits so they can scrutinize high net worth clients.
So, Mr. Kumar, how do they decide whom to audit and what are the factors contributing?
Absolutely, absolutely. So IRS is all about money. It's all about tax collection. There are several factors that helps in deciding who to audit. And we can list some of them for our viewers. But higher the net worth, higher the complexity in the return, the probability is high that something got missed. Say, for example, IRS, every single piece of income, the W-2 income, the 1099 income, all these income statements gets reported to IRS as well. So when you're doing your tax return and you have 15 W-2s coming from your 15 different business, several 1099s coming here and there, and you miss some of them, that's an easy audit. When you file the tax return, your documents wouldn't match with what IRS has been reported for you on your social security number, since all the W-2s and 1099s are reported to IRS anyway. So it's very important for you to make sure every single income is reported on your tax return. That's an easy audit. The other situation that gets audited quite often is the rental losses. So you have a pharmacy, several pharmacies, and you have a couple of real estate as well. So what the mistake people make, they will claim the rental losses as an active loss unless you are a realtor or unless you are in the business of flipping the properties, unless you are spending substantial amount of time on this business, as much as 1,000 hours at least. This business is not an active business for you. This is a passive side business for you. Read the word passive as a side business, not an active business. The difference is when a business is active business for you, the losses gets deducted immediately on your tax return. When a business is passive, the losses are suspended. So a lot of high net worth clients will have a lot of businesses, lot of real estate properties. In those cases, it's very important to make sure that the businesses, the rental businesses, the losses from those businesses are classified as passive losses. See, if you are making no money, if you are making $20,000 a year, then even if IRS were to audit you, how much money can they collect from you? On the other hand, if you are making $2 million, by auditing you, IRS can easily collect thousands of dollars from you. So if you look at the audit rate is less than 0.5% if your income is less than $50,000. Less than 0.5%. If your income is $1 million or more, the audit rate increases to 3.4%, 7 times higher if you're making more than $1 million. So these are the factors that the IRS is using to decide who to audit and how to target certain people.
Yes, Mr. Kumar, can you also explain us between the hobby income and hobby loss claiming on the tax return?
Yes, absolutely, Hema. So hobby income is taxable income. Hobby losses are not deductible. So the difference between a hobby and a business is the business comes with an intent to make profit. Hobby does not have an intent to make profit. So business income, business losses are claimed as deduction. So if you have an intent to make profit, even if it's not today, even if it's tomorrow, even if it's in 3 years, it's better to formally, officially start a business. If it does not work out, you can always close it. But at least while you're trying to set it up, the machinery, the client entertainment, the office space, the utility, the phone bill, the travel expense, all those can be claimed as a regular business expense, business losses, and it helps you save some taxes.
Just curious, Mr. Kumar, if you don't mind, can I ask you about how IRS identifies the cash transactions in the business?
Absolutely. So cash transactions are very hard to track. So there are several mechanisms put in place. There is a CTR, cash transaction report, that's filed if you take out or deposit more than $10,000 in your account. Then there is a 1099K that's being reported to IRS for all the merchant centers. So any merchant center that you use, they will issue a 1099K, even if it's cash transaction or a credit card transaction. But at the end of the day, it's very hard for IRS to see, to know how much cash a restaurant is collecting, how much cash a typical grocery store is collecting. That's why the cash intensive business gets more audit than a typical professional service company. Only because we know when you're getting a lot of cash and a lot of cash is being paid out as an expense, the scrutiny is much higher. The administration work is, there is more room to play with it. So IRS auditors, the revenue agents are trained to justify, to see based on the location, based on the zip code, based on the type of business you have, how much cash is reported by other businesses. Let's say you have 10 restaurants in the area. Everybody else is reporting $10,000 of cash collection in a month. I'm just giving you an example. And your restaurant is not reporting anything. Well, something is not right there. So they have a lot of statistics put in place in the software, Hema, to see how much cash is being collected. And that's how the revenue agents are trained to define, to justify, and they can easily request the bank statement. So if they see no cash is being deposited in your bank, that's not right. I mean, you have a restaurant, you have a grocery store. How could you not have any cash being collected over there?
Thank you, Mr. Kumar, for providing such valuable information and hope all the viewers liked it. Thank you.
That's great, Hema. Thank you, everyone. I hope you found this episode useful and you can have this information applied in your day-to-day life. Again, my name is Ajay Kumar. I'm an accountant, a CPA at Science CPA Services. Thank you.